Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, July 9th, 2019. It's a little after 3 o'clock Eastern Time as I'm starting this video, and what we're going to do is go over gold, the US dollar, and time permitting at the end, I'll hit on the other precious metals, silver, platinum, and palladium real quickly. But the big one's gold. Gold I've been bullish on for quite some time now. I think it, and I continue to believe it remains I can tell you it remains a core portion of my long-term funds as far as that's a strategic trade. I'm strategically or longer-term bullish on gold. Like anything, it shouldn't be half or all your portfolio. I think just a sliver piece of the pie. And so what I'm looking at right now is the next either swing trading opportunity or re-entry or add-on for a longer term position. So again, you can wear a lot of hats. I do personally. I'm an investor. I have long-term funds, retirement funds, kids' college funds, things like that. I'm also an active trader, and so I try to differentiate between swing trading or tactical trading opportunities and the longer term or strategic trading opportunities. So if you are new to the site, let me just give you a quick recap on gold. I won't spend a lot of time on it. This is a symmetrical triangle pattern I've been following for years now. Gold, we had a bull market in gold that ended back in 2011, followed by a vicious bear market, ended right here in late 2015, and since then gold was working its way up within this symmetrical triangle pattern. And so we had a breakout back here. It looks like about early 2019, late 2018 or so, we back tested, and going back to even back here at this bottom of the wedge at that pattern, bottom of the pattern back here, which goes back well into 2018. I had my initial swing target on a big target. 130 was that target on gold, and so we hit that recently, and we actually exceeded it. So in one of the recent updates, I said what I'd be looking for, because we had a very strong. This is what I refer to. It's a term I made up. I call it a momentum fueled overshoot. When you have a lot of velocity, upside or downside for that matter, if a security's falling, a lot of upward momentum, you tend to overshoot a resistance level or a target that it is likely to be the final target, or at least when I say the final, I mean initial target for that period of time. And that's what happened. You look at it, these are strong bars. That was a near vertical run in gold. And when you have so much upside momentum, the analogy I like to use, imagine a pitcher cooking off a 90-mile-an-hour fastball. The catcher's glove is going to snap back when the ball hits it, and then it's going to snap, after snapping back, it's going to come back forward to about the point that he caught the ball, or at least the ball met the glove. So that's kind of what a momentum-fueled overshoot is. You have a lot of velocity. You're not just going to stop on a dime. You're going to carry through there and come back. So now, what I was looking at before and still am is any pullback to that 130 area will be an objective long entry. Now we've almost had it, and I'll say this, that gold, I believe the long-term outlook is still very bullish. This is my next target and has been for a while, up here about 151 on GLD. Might come in lower. We'll see how the charts look at that time, but that's the longer-term outlook for gold right now. And so the 130 level was a very significant resistance level, defined by a lot of reactions going back for years. And so it should, quote unquote, should act as support on any pullback. So let me just keep it simple. This is a time to be scaling back in, or if you don't have any gold and haven't yet, I think it makes sense, it's objective at least, to scale in with a stop somewhat below. Now it's going to move around, so stop somewhat below doesn't mean 129.99 or 129. It all depends. It's relative to your target. If you're shooting for a long-term trade, an investment in gold that you think it's going up there, as I do, another 16%, 15, 16% or so higher, you can most certainly allow yourself a 2-3% stop. Even giving it a move back to 128 would only be about a 1.5% drop from that 130 level. So that's just in a nutshell my longer term picture, and that's why I'm doing this video now, because we're getting close there. But again, nothing goes straight up forever. Gold was overbought recently, and you can see this is another indication that we're now in a bull market. I've covered this as well in the past. In a bear market, securities, you remember, this is when gold topped, so everything from here to here was a bear market. And during a bear market, you rarely reach in this case, you didn't reach the overbought level until after it was over right there. So this is more indicative of bull market action. The fact we were overbought here, had a little pullback and became even more overbought, well above that 70 level. And then more importantly, as I talked about recently, we now have some pretty solid evidence that gold is in a new bull market. What I mean by that, well, I said before it bottomed here. The thing about that is an uptrend of any security is defined simply as a security making a series of higher lows and higher highs. So up until this point, we had, as I was focused on right here, even after the breakout of the symmetrical triangle, we then had a gold not yet taking out that previous high from 2016. So at this point in time, as you can see, we've now made, or at least recently, that is, in recent weeks, gold made a new high. And so when you look at it this way, here's gold, this is the uptrend, and especially considering the scope of the move, you can't argue anymore. This is not a bull market, or at least wasn't. Doesn't mean it can't end here, but I don't think that's the case. I think there's a pretty good case, both fundamentally and technically, to be made. So that's kind of the longer term outlook. Calling the exact entries and exits sometimes can be surprisingly easy in gold, but often it can be not so easy. So now let's take it down to the daily time frame. I have a couple boards here, but let's look at this one here. Back a few months ago when gold was pulling back, sort of like now, I said my preference was to scale in. And I had these support levels here from 120, 240 down to 120. The 120 to me was the biggest level. Very, very well defined, and it even goes back support level. And that was a nice area to scale into on and around. And I said worst case scenario, I would continue to scale down to 117.40. That's also pretty solid support level, and it never even got there. So that's why I like at times scaling in. And I can tell you right now, I think on any downside, down to about that 130 level, even a little bit below. I'm going to show you a level that we can take it down a little below 130 and keep scaling in and keeping the the longer term case alive. Let me flip over to another board here, and then go out here to 2-day period chart. Go back to that board. Where did we go? Okay, a little glitch with this charting software here, but you can see it here. Here's a line, a trend line, slightly downward sloping. You could also put a horizontal line there if you wanted, or here I'll box it in for you. So what we're looking at here is pretty much a series of highs right around that level, which comes in around 129. So that 130 level on the weekly chart, it's not a hard number. It's more of a range here. As you can see, gold had major resistance there around 129 to 130. And it's slightly above that level now. Now here's the thing to consider when a stock is in an uptrend, if the chart is bullish, that if all eyes are looking for a pullback to say 129, what gold will do, or most securities, is not give you that easy entry. They don't like to make it easy. So if I'm longer term bullish on something, I'm not going to try to eke out every penny on a pullback. I'll scale in down to, and then not far below that level. And you can see this trend line. That's what I wanted to mention to you, that if you take a trend line off that 2016 highs, it's slightly downward sloping. So this is what it looks like to me. It's objective to scale down to this level, probably no more than down here at this point in time, and that's percentage wise, again, that's not too much in gold. It might look like a big move. It's 5.5%. So if you're looking for 15% upside, 5% stop from where we're at now, still looking at a 3-to-1 risk reward ratio, which isn't bad. So that's that's kind of my outlook and take on gold now. I may add it back as an official trade. It was an official trade back here. And when the stocks were melting down in the fourth quarter, gold wasn't yet responding, but I figured it would, so we took this breakout right here. There's our entry price. Boom, 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 boom. Hit our third target. We got out not too early, a little bit early there, and then gold put in a divergent high, and the rest is history. The divergence you can see here on this chart. And that was a divergent high pointed out at that time. Then we got a correction. So we got out there a little before the top, sidestepped that big correction, at which point I mentioned, and is an unofficial trade is just a good idea, long-term trade to scale into. And And so we've had this rip. So I know a lot of you hold gold in your portfolios, and again, I'm viewing this as having a, the way I like to trade it, a core position which I'll strategically trade around. And at this point, looking to start to add back some exposure that I lightened up on recently. And may make it an official trade. It's just sometimes hard to, when I look at the charts, some of the chart patterns, as you guys are probably familiar with, wedges, trend line breaks, solid support levels, you have those clear entries that are well defined. And in other securities, especially like gold right now, it's more about a range. So that's kind of what I'm looking at here is, scale out, lighten exposure when gold looks like it's getting a little lofty and at resistance after an extended run, and then start to scale back in on the pullbacks. Okay, before we leave the daily chart, we're going to get to the currencies here because that's a big part of my analysis. So here's what we have. We have a high-level bearish PPO crossover. We had an extreme overbought reading in gold. We don't yet have a divergent high, and that's a possibility here too. We may see, here's an uptrend line I added. We may get one more thrust up, and if we did soon, and we made lower lows on the PPOs I'm drawing out here in the RSI, that would give us a divergent high once again like we had here, possibly setting the stage for an even deeper correction. So if that happens and you're scaling in now and suddenly we turn up, get a divergent high, and then I see something else in the charts that warn of a correction, maybe you get back out of that position. But I'll tell you, I'm looking again to position for the next leg up, scaling in here, and I can't tell you if that next leg up starts tomorrow or starts 2-3 months from now. As long, and time is not as important to me as in price. As long as we don't violate those, drop much below those levels I talked about before. Let's see if there's anything for you on the 60-minute chart. Looks like I didn't really have it marked up, but I can do that for you right now because I have a similar setup on the gold futures. You can see, not a very well-defined trend line. Let's not even look at that chart now. I'm going to show you some others here. Let's look at the GLD 60-minute chart. I've shared that the last couple mornings on the front page in the updates there. So you can see again, sometimes I'll use the futures. Yes, I realize that a lot of traders out there don't trade futures, don't have access. You can get free futures charts from investing.com. This one is from Interactive Brokers. It's a trading their charting platform, that is. There's the uptrend line, fairly well defined there. We broke down, and the other day I mentioned we back tested there, and we came off the back test. You can see right here the gold's holding just above this 1385 support level. If that goes, you can see the next support down here. We don't have decent support, and it's not great support, but decent there around 1344.70. And again, we're just looking at a 60-minute chart. The other support levels I showed you on the GLD daily are pretty significant levels. And by the way, GLD, even though it's an ETF, does a very good job of tracking gold, number one, and a lot of institutions, big funds, will even use GLD as their proxy instead of gold futures. So I'm fine with tracking, using the charts at GLD to determine my entries and exits, where sometimes I, especially like with agriculture commodities, I lean more on the futures charts. So there's some levels to watch, and I really think if we get a pullback this deep to about 1318, that should hold. There's a lot of, you can see a lot of trades when in this, we had a sideways trading range for a while here, and the top of that level is pretty important resistance. If for some reason it goes, that should be the final straw that should hold there, 1273. I am not expecting that deep of a pullback, but anything is possible, so we'll just have to assess the charts as they come. So I'm looking for something more along the lines of something like this on GC, that's gold futures. Okay, one of the reasons that I've been bullish on gold and looked for the big move coming, a lot of that has to do with the U.S. dollar. Now we can look at the dollar, you can look at the dollar index, or you can look at UUP, which is an ETF that tracks the U.S. dollar index. I didn't put a chart together for this video, but I've done this many times in the past, and if you're a new member, I'll be glad to dig it up and find it. But I've put up the charts in the past that show an unmistakable correlation, inverse correlation between the US dollar and gold, meaning one goes up, the other goes down. Now, a little caveat to that, Correlations sometimes have periods of temporary disconnects, but I'm talking a correlation that goes back for not just years, decades. And it's very simple. It's not a magic thing that happens. It's that gold, at least the gold we're trading here, if you're trading GLD in the US or gold futures, you're trading gold that's priced in US dollars. So it's very simple. If the US dollar drops 10% in value, it's going to take more dollars to buy an ounce of gold. If the US dollar goes up in value, it's going to take fewer dollars to buy an ounce of gold. That's why you have an almost perfectly inverse correlation, not in percentage terms, but just one goes up, the other goes down. Here, you know what, it takes a second, I'll show you. And again, this is again for new members of the site that might not be aware of that. Here, let's just pick here, we'll do a white GLD. There it is. So you can see here clearly, and then on a 10-year weekly chart, you see the dollar falling, you see gold going up. You see the dollar bottoming right here. What happened? Gold bottomed. Dollar went up, gold went down. Pretty simple stuff, right? Dollar goes up. Remember, the green and red here is UUP, the dollar index. Gold goes down. Gold goes up, dollar goes down. So that's that. Trend has been up. There's a disconnect. That's what I wanted to point out. There's temporary disconnects right here. We have to zoom in. Let's see. At this point, they were both going up. Well, not for very long. That disconnect only happened. Looks shorter than it looks right here. Right here to here, the dollar went up, while gold went up, but then gold started going down. After that, you can see a little later, the dollar started going up. Gold down, the inverse relationship continued. But again, like I said, there are temporary disconnects, and I say that because every now and then someone will say, well, gold's been going up in the dollar too. Any two asset classes, all the ones that I've tracked over the years, you will see these temporary disconnects, but when you take a look at the longer term trends, it's unmistakable, and again, for the fundamental reasons that I stated before. So with all that being said, as I often say, any analysis on gold, in my opinion, is incomplete without analysis of the U.S. dollar. I'll do that to help align or contradict. Maybe I'm looking at something gold and I'm thinking it's bullish. Meanwhile, the dollar is looking very bullish as well, because remember, there's that inverse. That might not mesh, and that might tell me, Randy, take a step back. Maybe your analysis on gold is wrong. Maybe, charts might look that way, but it will be hard to imagine a rally in the dollar with a rally in gold at the same time. Again, it can happen, but for the most part, you want to put the odds in your favor, and again, that's why I like to look at this. So what are we looking at here? Same old simple stuff I like to look at. I look divergent lows in the dollar lead to rallies. Divergent highs, there's your negative divergence, correction. There's your bullish divergence, rally. And most recently, and again, this is a weekly chart, so this kind of pattern here, which is a bearish rising wedge, isn't for swing trading for 2-3 days, 2-3 weeks. This is long-term stuff. These are trend changes that are usually months, if not years. You can look down below, see the calendar years. So when you're trading off the weekly chart, this tells me we're looking at quite likely a very major top in the US dollar, meaning the dollar will fall in the coming months to years if this plays out as it should, or at least as the charts indicate, I should say. So what are you looking at? Here's the top in UUP. It's come up to this level several times in the past, and it's been rejected each and every time in recent years. Add to that, we have the bearish rising wedge there. You can see it right there. You can see the negative divergence confirming the bearish nature of that wedge, and you can see we had a breakdown, an impulsive breakdown, and we're currently back testing the wedge from below. Now I like to use, that's an ETN that tracks the dollar index. My preferred trading proxy or charting proxy is the Euro US dollar pair. The euro is by far the largest component, makes up well over half of the US dollar index. So when we look at this, it's like flipping the US dollar chart upside down, because this is showing you strength in the euro or weakness against the dollar. So in other words, when this chart goes up, the dollar's falling, so gold should be going up. And so again, this plays into my analysis for gold. Remember, I told you gold bottomed back here late 2016 by absolutely no coincidence. That's when the euro US dollar pair bottomed, or the dollar topped, and then you had that big move up, and there was a strong rally in gold at that point. Gold put in up to that point a high, which was only just recently taken out. And then right here you had what happened recently is gold started moving up in advance. And again, this is why I'm doing this video, and this is why I've been bullish on gold. And if you followed the site for years, you know that I've almost always preferred to trade the miners instead of gold. As I like to say, trading the gold mining stocks is simply a leveraged trade on gold, because that's what it is. The miners, when the price of gold goes up or down, their bottom line is affected tremendously. So if gold goes up 10%, usually the miners will go up 20%. And if gold drops 10, they'll drop 20. It's not that exact 2-to-1 ratio, but there is a the miners tend to rally much more in percentage terms than gold. However, there are times, and the reason I've been bullish since most recently since last fall when we went long gold officially, is a fundamental play. And there are times where the technicals on the miners might not be as strong, and I've seen this, I saw it trading the bear market in 2007, 8, and 9, where gold was rallying, but the miners weren't. Remember, the gold mining stocks are exactly that. They are stocks. Gold is not a stock. It is a commodity. It is a precious metal. It is a flight to safety asset, but it's not a stock. Gold mining stocks are. So where I'm going with that is, if we were to get in a market meltdown type situation, we're not there right now. We might not be for a while, who knows. Gold tends and will likely outperform the miners. So just keep that in mind. When everything's relatively stable and gold's rallying, the miners will rally, and then more so than gold. So I wanted to make mention. Now, where I'm going with all that, I know I'm all over the place here, is that, gold here, you already know what it's done. It's rallied despite the euro falling and the dollar going strong, and that was that disconnect I showed you on that other chart. Why is that? Well, because again, it's always been historically. Forget about Bitcoin, forget about these cyber currencies, these alternative things. For hundreds of thousands of years, gold has been a store of currency. It's been a value. It's been a form of currency, and it's always been a flight to safety asset. And until that stops, it will probably continue to be. So when there's either market volatility or the expectation of market volatility, I know, like a lot of people know, that this bull market will not go up forever. The Fed is not all of a sudden omnipotent. They haven't figured out, finally, after all these years, the way to stop a recession. Recessions are as natural as anything else in economic cycle. We have recessions and contractions. We've now entered the longest economic expansion in history. So a lot of institutions, I believe it's institutions, smart money, wealthy individuals, have been moving into gold. So again, we go back to the gold chart, and you can see that gold's been moving up along with the dollar. That tells me all of this is pure demand for the flight to safety asset component. People want gold in their portfolios now. The stocks are getting lofty. I believe a lot of people think like I do, that, hey, the trend hasn't showed us it's reversed yet, the longer term trend, but the risk reward to stocks is very unfavorable at this point. In other words, the next 20 to 30% will most likely be to the downside from here before the upside. We might go up 10%, 5, 15, but this market probably doesn't have another 30% left in it. So money's moving into gold. And what makes me so confident that that's a flight to safety asset? Well, I already showed you it wasn't currency related. And then we look at the other precious metals. They're not doing so nearly as hot. There's silver, which is next down. Silver is, as gold is, both an industrial and precious metal, but gold's the one that people flock to safety for, not silver. So this shows you that the demand in gold has been people moving money out of stocks. Other countries, China's been a big buyer of gold, some other countries have. So that's that, and I think that trend will continue. And so imagine, again, if gold has been this strong over the last, since late last year, or really since late 2015, imagine what will happen when you have a falling dollar as well. That will be a turbo boost, if you will, to gold, especially, again, if you get that market volatility. That trade can go the other way, the flight to safety trade. If the market continues to climb throughout 2019, sure, we might get the flight to safety bid may come out of gold, but at that same point in time, you may finally get the other bid, which is, or not bid, the factor, if you will, this chart playing out. So as I said, if the euro US dollar, if this chart plays out, which I don't see why it wouldn't, nothing's guaranteed, but it's just we're here on the weekly chart, a beautiful bullish falling wedge, just like that UUP dollar chart I showed you had a bearish rising wedge, because this is going to be in reverse. You had a breakout, hit my first target here, which was 113,568, and we broke out, and we're coming in for a near back test. So this is what I'm looking at, and this is why I'm doing this video instead of just putting up one or two charts. I know these videos take a while to listen to, but it helps. There's a lot that goes into my analysis, especially on something like gold, and that is GLD is pulling back, has overshot that 130 level, 129, 130, and is coming back in for a back test after a momentum fueled overshoot, number one, which helps, set the stage for another objective entry. At the same time, the euro US dollar finally broke out of this bullish falling wedge that I've been tracking for over a year now, hit the first target, and is coming in for a back test, which is an objective entry. Here, we'll extend that line a little farther. So we come in back test. There's also a key support level here about 111,240. So anything down here, this is my expectations, what the charts indicate. We come in a little more, that would bring gold down as well, and then boom, off to the races to hit my next target. And this leg up, if we get it, should be very bullish for gold, because that means the dollar would be falling, the euro would be climbing, and the dollar falling. So that's the next target. You can see it's a pretty well-defined level, and then we get something like this and continue on. This is a big wedge. If you take the widest part of the wedge, add it to where the wedge broke out, that would give you your measured target, which would probably come in right around there somewhere. So that's quite a bit of upside. We want to kind of sharpen our pencils. We'd go down to the daily chart. I know this looks a little bit busy. I have multiple trend lines, but it's the same chart I've been sharing in the past here. There's your wedge, the lower wedge right here, that white trend line. I had an alternative yellow trend line off the top here. They came in roughly together, so I'll leave it on there. There's your breakout, back test number one. We went up, and if you recall, I had another trend line here, which we just hit recently, and now we're coming back in for another back test. That wasn't random. We hit that trend line was there. I tweaked it ever so slightly recently from the previous videos, but it's the same trend line I had before, and it was also my next target, which has now been hit. So again, the pullback here was not surprising. This is why recently I was staying away from gold, because I was somewhat neutral. All these, the euro running into resistance, gold overshooting that level, but I think we're looking at the next objective buy point. If this happens to coincide with a top or a pullback in the market, all the better, because that would give gold a flight to safety bid too. So this is my expectation. We've already tested that trend line once. It had a rejection. So if we do reverse soon, I expect the next time we hit it, maybe get a minor reaction, but I think we'll take it out and then move up to my next target here, which runs from, you can probably see there's a line there, about 114,996. So we'll call that about 115 on the euro US dollar pair. It's more of a target or a resistance zone, and a little reaction there, and then we come on up here at about 118. And if that happens, that would be very bullish for gold, with the dollar falling as the euro climbs. Okay, sorry for the pause there. I tried to pause the video. I was loading up GDX, trying to decide which chart to start. All right, everybody loves GDX. A lot of people love GDX. Always get questions on this one. Why? Well, the miners, they can put a lot of money in your pocket in quick order. They can also take a lot of money out of your pocket in quick order. They move. They're very volatile. The individual miners, I've traded these things many years, and just about all of them can easily go up or down double digits in a single day, 10% or more. It's not unusual during the big rallies. Not every day, but when they're trending, and they can trend strong. So here's an example. 2016, that rally from the lows to the highs, which was 6 months, was about 150%. Now that's a sector ETF. That's not individual stocks, or individual stocks that did many times that. you're not going to see the stock market rally 150% in 6 months. That's why people love to trade the miners, myself included. So what do we have on the miners? We had my target here for a long time has been 20.51 or $20 I should say, $25. What am I saying? 25.01. We'll call it 25. Just like gold, I had a big, beautiful, symmetrical triangle pattern here. And just like gold, we broke out, we back tested it, came in on that support level there. Beautiful back test of the, and then popped right up to that $25, 25-ish target. And you can see if we zoom in tight, look, there's been several reactions. I can put another line up there. And like I said, it's not a hard number. 25 up to about 25.50 if you count these previous reaction highs, maybe even a little higher than that. And so we overshot it on what I call, again, a momentum fueled overshoot, and we came back in. So it's quite possible that the miners are flagging here. This is flagging type action where you have an impulsive move up and then a period of consolidation followed by another move up. So that is very possible. Near term, my read is not very strong. The miners certainly got a little bit ahead of themselves, but I want to say this. Don't underestimate how far and how overbought these things can run. If you're thinking you're going to short the miners because they're overbought, be aware that, as I just showed you, when they want to run, they were probably overbought. Well, they were right here on this weekly chart back here. And what happened from that point? They became overbought, from oversold to overbought on the weekly chart. They went up almost straight up about another 60% from there. So you never short a stock or security solely on the fact that it's overbought. And you also need to recognize that some you actually can. I've gone over a lot of stocks over the years. They hit overbought. It's almost like clockwork. They correct. Just you need to know your security. You need to know that the miners, natural gas, for example, when they become overbought, that sometimes is only the beginning, and they can continue to be overbought a lot longer than you think, and with a lot more money than you have if you're short. So I just wanted to say that overbought is certainly a sign that, hey, you might not be the most objective time to buy, and it may provide a great shorting op, but not necessarily. You need to have the evidence in the charts, other things that tell you to go ahead and short it. So there it is. So that's the gist of it. GDX has had a strong run up, just like gold, right into resistance. Probably needs to take a little more of a breather here. Maybe not. Would be preferable, in my opinion, if it did. And then again, look for those other things I could talked about, such as the U.S. dollar, euro backtesting. Here's the GDX 60-minute chart, and you can see on GDX, unlike gold, we had a divergent high recently. There's your divergence right there, negative divergence. So the miners were a little hot, and they're correcting more so in time, a little bit in price, but more so in time so far. Let me check the time on the video. Darn, I really wanted to go through some of the individual components to kind of give you my thoughts on it on GDX, but there's just not a lot of time. I could rifle through a few of them here, like Newmont, and show you a lot of these are at resistance to have these strong runs, so they're just getting a little bit stretched, really, if you will. And there's some uptrend lines to watch as well. So, kind of what I said earlier. There's certainly the potential to make more money in the miners, but if you're looking for something not so volatile and a way to diversify your portfolio, I think gold, you're not going to get over the long run as much as you'd make on the miners, but for those of you on the site, and I know there's quite a bit that don't tolerate volatility very well. I've seen that recently. Gold's going to be your better fit than GDX. And if you want to diversify, there's nothing wrong with that. Have some gold, have some GDX. Just keep in mind how volatile GDX is, and as far as your position size. So what I mean by that, let's say you want to put 100,000 into gold and the precious metals and silver, platinum, whatever else, the mining stocks as well. That's your allocation of your total portfolio that you want in gold, then, or gold related assets. Then you might in that case put 50, 60,000 or more in gold, sprinkle some among the other precious metals maybe if you want those, and then the miners might only represent 20,000 or maybe no more than 30,000 because they're more volatile. You're going to have more bang for your buck on the upside, but it cuts both ways. Okay, we're almost finished, so I'll wrap it up with just a quick overview of the other shiny or precious metals, silver, platinum, and palladium. Here's silver. This is a long-term chart, a weekly chart, and you can see, just like gold, they're going to move roughly together. As I showed you, gold has outperformed recently, and as I illustrated, that was due to a flight to safety bid, not other fundamentals such as the US dollar or anything else. So this was the bear market, and so here's your bull market. It was almost a parabolic top, looked like the dot-com bubble. Look at that beautiful little doji up there. And then it's set up in this big giant bullish falling wedge pattern right here, and just like gold, it bottomed back in late 2015, early 2016, broke out above the wedge. Now here's what we're watching. Just like you had this downtrend line, that was a buy signal here on the breakout, you have this downtrend line to watch. And I think silver will play a game of catch up, maybe not 100% to gold, because again, it doesn't command that flight to safety bid that gold does during times of market volatility. But you can look at things like the silver gold ratio. Stockcharts.com will provide that chart, some others will, and you can see that silver's been underperforming, and usually when that happens, they play, there's a mean reversion there. So silver looks pretty good, and there's you want to know where to buy it. That's the long-term buy signal will come on a solid break and weekly close. This is a weekly trend line above that downtrend. Silver also has resistance from that 1470 level, you can see, and I'm going to add a second line here, and I'll show you why in a second, about up to about 1521. Zoom in a little tighter, see these two candles there, those tops, and a lot of candlestick reactions there. You can see a lot of candles tagging it from above to about 1521. So to put it very clear here, we have a downtrend line, which I put probably the highest weighting on, but then we also have a resistance zone just above there. So the safe bet, in other words, that would be your first buy signal. You can scale in, continue to add, but then finally add on a solid break above that 1520 level. That should open the door for a pretty good rally in silver. And again, that's the longer term picture. So right now, silver is still in that downtrend under that line. Here's what it looks like when you zoom down to a daily chart. This was what I call AD, or almost divergence, meaning you had a almost equal low but a slightly lower low, but you had much lower low in prices, and so that it's comparable for all intents and purposes, does what the bullish divergence like this does right here. You had equal lows with higher lows on the indicators. Boom, that led to that rally. That ended with, you got it, divergent high right there, negative divergence, boom, correction. And so there's that almost divergent low right there. And you can see some levels. This right here is a pretty key trend line. Goes back a little ways. Let me show you. Comes off the... Well, I'll draw it for you here. Let's just do that. There's that trend line. Up there it is. I have it coming off. We can do it this way right here with that white trend line, or the blue trend line comes off these that reaction high there in early 2017. And I think that one's a little bit better fit, but they're both significant. You can see there. So this is what silver has to work its way through on the daily chart. Those downtrend lines and these levels there. But once it puts about 1640 in the rearview mirror, it's all blue skies in my opinion. So that's some work to be done. But again, I'm giving you the longer term and the intermediate term outlook here. So like I said, it's got some work to be done. But if it can get up to that level, which I think is very, very possible if it takes out these trend lines, that's about a 16% rally up to that 1640-ish level. And then probably take a run after that if it can get through there, make a run at those 2016 highs. PPLT, platinum, I'm not going to bore you with it because there's not a lot there. I'm looking at really this trend line here, potential downtrend line. You can see resistance about $83. I'll round that off. It's only a penny under. So you're bounded by downtrend line plus price resistance around 83, pretty significant level with this uptrend line. So if you want to trade it, I can say this. It's objective to go long on pullbacks to this trend line, targeting the upside of this range here. And so if you get that soon, if we get another pullback to that level, that would be, clear that out. Okay, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.